All right, good afternoon. Welcome to the weekly take on the market. Today is Friday, May 24th. It's just after 1 o'clock Pacific time. So the market has closed. And this is your weekly take. I will be your host as usual. My name is Scott St. Clair. I'm manager of the Premium Product Group here, Investors Business Daily. The disclaimer. I'm not licensed. Nobody at IBD that I'm aware of is licensed. We don't offer buy, sell, hold ideas. Can't tell you how many stocks to own, when to sell, whether you should keep buying more of your NVIDIA, et cetera. But we do have skin in the game. We are allowed to invest our own accounts fairly freely under a compliance umbrella. And so that's one of the great perks of working here. All right, so same old story, right? Overall market thoughts, industry groups, stocks to watch, and then quote of the week. So from top down charts, the Euphoria meter, very interesting. First time I've ever seen this. I don't know how they create it, but as a general rule, the higher the market goes, the more euphoria exists, almost always. And as a general rule, the lower it goes, the more what's the opposite of euphoria? Despair occurs. And we're at the highest levels since the mid 90s. It's kind of strange. A lot of the VIX is very low. I think I'll pull up the VIX. It's like I thought somebody said it was at a X number of year low. But Charles Harris was on IBD Live this morning, and he talked about how he didn't feel like there was that much euphoria, even though the indicators seem extreme to one side, but his overall like feeling, maybe amongst his colleagues, maybe amongst the people even that we watch on IB Live, and even for myself, I'm not over my skis long, and so but I tend to err on the side of caution probably a little bit more than most people. So I don't know if that's a good indicator for that, but I kind of agree with them, even though it seems the indicators seem euphoric. I don't get that impression on the quote unquote street that people are euphoric. I know what euphoria looks like. I mean, I cut my teeth in the late 90s. That was euphoria. I went to the gym and every TV was on CNBC, and you went to lunch and every TV in the restaurant was on CNBC. That was euphoria. I've got so many stories. I could write a book on the 90s and the crazy euphoria stories that I encountered. And this is nothing like that. Now, I think the AI thing is a little euphoric for sure. It probably have the cart before the horse a little bit. Most of the companies probably will never see a profit. In fact, I was reading about a lot of AI startups that are actually already going out of business, raised $1 billion, and they're not generating any revenue. They sure are buying a lot of NVIDIA chips, it seems. So there's a few companies that are really prospering at this very moment on that. But it's not across the board like it was, at least in the 90s, if that's any kind of indication. Speaking of AI, I thought this was a cool little chart. Peter Atwater, proportion of S&P companies mentioning AI during their quarterly earnings call. Looks like a climax top until it maybe goes even higher. But this is what sentiment drives the news. And so as more and more companies realize they have to kind of be in the AI field, at least somehow, some way, they start to manufacture the slightest ways to mention AI just to kind of keep up with the Joneses, so to speak. Berkshire, their cash pile. Game of Trades I think it's his Twitter handle is where I got this. I think this is a record, yes, since again the early 90s. Now, keep in mind that he has a lot more money now, but you can see how he got pretty negative relative to the cash pile in the 90s, in late 99. And he was probably a bit early. I remember there was talk that Buffett had lost his way. think there was even a magazine cover about has Warren Buffett lost his way in the late 99 period, I think, when the market was really running and he was underperforming. And so maybe he's getting in front of something. I don't know. It's not his type of market. Probably it's a very weird or strange market. And we'll go through the indexes. So it's not as, I don't know, for me anyways, it's not as easy as it seems. When I just focus on the stocks that I really like and stocks that are acting well, I tend to just kind of ebb and flow with them. And I avoid the indexes as much as possible because for me, I know it's not for everybody, but for me, I find the indexes are just designed to fool you. Look at yesterday was a great clue. Like you had an outside day down, you have all the buzzwords, and what happened? NASDAQ's soared today. So these indexes are a little tricky. You have to be, I think, careful to read too much into them both ways, bullish or bearish. So we'll see. We'll see what this means going forward. Let's pull up the indexes. So let's start with, well, we'll go the good, the bad, and the ugly, but we're going to go in reverse. So the ugly is the Dow. Now, I don't know if the Dow matters. I think it does a little bit. It doesn't quite have the same, and I'm going to turn off my camera. And on a side note, I apologize. I've tried to figure out a way to move my camera. I can move my camera, like I'm moving my camera, but I don't believe it's moving on the recorded version. So I could put it in the bottom right corner. But when I watch the videos, though, I think it's always in the same spot. So I'll go back and forth on the camera. I spent a long time talking to my colleagues. I really try to figure this camera thing out because I know that a lot of you, we get your emails, obviously, and I try to respond to all of them. And a lot of you have mentioned the camera, covering up the charts. And so I prefer to have the camera on. I feel like I just feel more engaged when the camera's on. But I also get it with the chart. So I'm going to go back and forth with the camera off. So until I figure out the solution. Maybe there's a Zoom expert out there that can tell me how to do this. All right. So stop video. So you have a bit of a divergence, right? Here's that marked high that I talked a lot about. And the Dow failed at that marked high. And even today, the Dow was down, even though most of the indexes were up. So I'm actually short the Dow through ETFs. Why? Well, it looks like it's going down, one. But two, also, it's nice counterbalance to all the longs I have. And so I just feel a little bit more comfortable when I'm really pressing the long side to have something on the other side. Now, if the market just got crushed, I'm going to lose a lot on the longs and make a tiny bit on the Dow. You're not going to get rich shorting the Dow, but psychologically, it just feels better. Maybe it's just a crutch. So this looks negative. You have a potential negative divergence. Look at the relative strength, just really bad. So this looks like it's going lower. And if this was 1912 and this is the only index I had, I'd be pretty bearish on the market, actually, to be honest with you, even though it's still above the 50-day and the 200-day. I don't want to read too much into it, but it feels like that's going lower. The good, well, I wouldn't say the bad, but the medium would be the S&P. It's still holding this marked high. You see how yesterday it came down, touched it, and then today we were up 0.7%. So nothing wrong with this. And now the good is the NASDAQ. So the marked high, much higher than, see how it's much higher on a marked high basis than the S&P. And also this is an all-time closing high for the NASDAQ. So there's a bit of a divergence. NASDAQ really strong, S&P fine, Dow weak. And then there's some others that I don't watch, but I know some of the guys on the IBD Live team will mention, like equal weight. So this is the NASDAQ 100 equal weight and didn't make a new high. So each stock is the same percentage versus the QQQ is I'm gonna mess this up. I don't know if it's market cap weighted or price weighted. I think it's market cap weighted, but it's weighted, and just give in that regard. So Nvidia has a greater proportion influence on the index than, say, Deckers or something like that. So and Apple, of course. So that and I think is it RSP? Is that the S&P equal weight? Yeah, so you can see the S&P equal weight didn't make a new high as well. So there are some signs of negative divergences, but it's probably if this is going to play out negatively, the signs are very, very early. So keep that in mind. So the NASDAQ obviously is the best. What else from an index standpoint? Let's look at gold. So commodities were doing okay, and then look at gold. It tried to break out, failed. I don't know what the ticker for copper. I just know the future ticker. That's the one I watched. But copper was running and then got hit pretty hard. Silver was running really hard, and it's pulled back a little bit. I don't see a problem with that. It seems pretty standard to how strong. I mean, it went from 24 to 29 in a hurry, but commodities have come off just a little bit. And then last but not least, I do watch the bond market a little bit just because it stirs the drink on the indexes. And if you can see, I've got like a little trend line drawn right there to see if it were to come out of this little area. This is the TLT, a mixture of long bonds, long-term or long duration bonds. So I think Charles Harris or Jim Ropel, I think they both said that we're in a bull market, and that's about as simple as you can keep it. We're in a bull market until we're not. And the NASDAQ, I think, is you're in a bare minimum. As long as it's above that, you give it the benefit of the doubt. And then if it were to go below the 50-day, and then ultimately the 200-day, all bear markets pretty much occur below the 200-day or the 40-week. So here's the COVID bear market. Here's the excuse me, the what would I call that? The growth bear market, the ARK bear market. It's kind of where all those types of stocks, the Shopify's of the world, topped and went down immensely more than the market. So you can see, like, even though this is very short-lived, below the 40-week or the 200-day is where all the real trouble will occur. So you're splitting hairs until that point. I think as long as we're above this line, if you're a long-term investor, if you're a medium-term investor, you got the red line. And if you're a little shorter term like me, I think you've got like this line in the sand. And so there's some downside targets if you want to become more defensive and or bearish. If you like to go short, I besides the Dow, I'm not short any individual stocks and haven't been for a number of months. It's been a long time since I've been short an individual stock. And even the Dow is a relatively new short. I think I'm been short for 3 trading days or something like that. So I think overall it's fine. The market's fine until it isn't. All right. So let's go to the industry groups. And computer hardware is 1, building maintenance is 2, heavy construction 3, transportation ship. Like that group. That group has really started to go up. I feel like I missed it a little bit, but LPG is starting to act good. I actually bought a couple days ago this, or yesterday, I think was my first buy. I'll pull it up. A new issue in that area. So that seems like a pretty good group. Equipment manufacturing, don't know much about that. Software database. Software looks a little tired. Let's pull up ServiceNow for sure. And I wonder if the market worries, like this is from a macro standpoint, this is kind of what I think, because I don't know. And I wonder if the market is worried about AI and people being able to use that versus the software that they use. I don't know. Interesting thought process. But ServiceNow really is the leader. So I would watch that one for sure. Mining gold is holding up okay. Semiconductor fabulous. Data storage, steel specialty alloys, very interesting. Food, meat products, interesting. Electrical power equipment, I like that group. It's kind of an ancillary ancillary way to play the whole AI thing. I have a couple of positions in that. Or no, I don't own CEG before. I'm out of CEG, but I have POWL, POWL, which is on my list to review. Product electronics, mining metal ores, retail restaurants, CMG. I'm surprised shoes aren't in here because like Deckers had a great, I don't know what it did yesterday, but it had a great day the day before. I think that's when it gapped up on earnings. We'll pull up the chart. So the groups are fine. And I like the diversity of the groups. Transportation ship, that's not exactly the first group you'd think of in a bull market. Building maintenance and services. So gold, silver. So it's very eclectic market. That's why I think it's not a traditional bull market besides the obvious one of Nvidia. Even like SMCI doesn't seem to be holding up that well. It looks broken to me. And so it's very stock pickers market, everybody's favorite saying, a stock pickers market. Like I think the reason people laugh at that is because like when is it not a stock pickers market? But sometimes when it's a little bit narrower, they would say, well, it's a stock pickers market because you got to really be in the right areas. All right, so let's start pulling up stocks. I'm going to turn off my camera. And let's start with the best one, NVIDIA. Gaps up on this earnings report. I just don't know how it's just incredible. 460%, revenue up 260%. I cannot recall ever seeing numbers like this on a company, definitely the size of NVIDIA, but even the company would be half the size of NVIDIA. These are just incredible fundamental numbers. Now, you can see the estimates are that they're going to slow down. It seems almost impossible for them to stay the course. But I'll tell you, these estimates, like this number, which is why estimates are low on the totem pole for me. I don't know when this changed, but a day or two or a week ago, that number was negative. I'm distinctly remember minus 17%. And these numbers weren't this strong. So you see what happens is the street now is, if you said, oh, NVIDIA is going to slow down, therefore I'll be out of that stock. And the problem is, the street just changes their numbers and voila, it looks like, oh, why did I get out? Well, when you looked at those numbers, they were bad. They were slowing down immensely. And so that's why I don't use estimates like other people do. A lot of other people love them. This is the reason I find is that they can change them so fast. But you can see what's happening if you follow them. You can see that the street is really ramping up their estimates going forward. And the stock, I mean, honestly, I felt it was a little wedgy on the way up, but when it's the best company, the best stock, you have to kind of give it the benefit of the doubt and not be so concerned with the pattern. Now, I don't own NVIDIA. I own it the chicken bleep way, which is this with NVDY, which is an ETF, a yield ETF for NVIDIA, where they're buying calls and selling calls to create yield. And if NVIDIA goes up, this will go up, and vice versa. It's just going to go up a lot less than NVIDIA. And if NVIDIA goes sideways to down, it should go down a lot less than that. And so I just kind of lost my nerve for the stock. I felt like it was, let me say it out loud like an amateur, too high. When I used to go on the road, I'll turn my camera on. I think it's an important story. And one day I hope that we go back out on the road. I used to love to go on the road and meet people and talk to a room, 200-300 people that would come on a Saturday, because anyone that would go to a hotel on a Saturday you're really into the markets. There's a great group of people that were highly motivated. And I used to always tell the story that I didn't do this, but I should have done this. Is everyone in the room raise your hand and tell me which stock you think is too high. And I used to always say, like, Tesla. That was the one I thought was too high. And you all know what Tesla did. And I think the stock that the majority of people, it had to be like a leading stock that I wanted you to say it was ahead of itself, so to speak. And that was always the best stock to own, regardless. So, and NVIDIA's proof point. So Jesse Livermore used to say, stocks are never too high to buy and never too low to sell. And NVIDIA has really pressed home that point to me. I feel like I have to learn that lesson every 3 or 4 years again in a super stock. So they're never too high to buy and never too low to sell or to get out of if you're in them. Not necessarily have to sell short. All right, so NVIDIA, it is what it is. What about Meta? So gaps down and it's holding. Actually, if it gets above that, some people might even buy like that. So it seems okay. Apple, I do not own Apple anymore. I want to, but gosh, I just wish the relative strength would improve, and I would like to see like a single quarter of this. So I just kind of got wore out that the story, the narrative of why I owned it, maybe is a long-term narrative that maybe would probably not allow me to participate in. Microsoft, it's kind of going to be a market type stock. The relative strength is 80. Amazon seems okay, not great. Relative strength 87. And Google, so not much there. It's fine. Let's go to ServiceNow. So let me. And so it's not a good day last couple of days. It did what people probably thought the market would do, closed on low and actually went lower the next day. And look at the relative strength is really starting to roll over. And pattern's not all that great, right? A little wedgie, up, 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 up. So I think I wouldn't short ServiceNow. It's such a great company, but I definitely wouldn't be long it. I think it's an avoid. Let's look at DEC. Was it today? Yeah, so today gaps up on earnings. Really strong quarterly results, 43%. A great company. This is another example. I can tell you, I always thought Uggs were a fad that would go away. And I remember one time being at Costco and a girl came running down the aisle holding some fake Uggs saying, "Look, Julie, these are $50 or whatever." And this is a monthly chart of DEC, so let's go to best fit. And I have to be honest with you, I don't remember where that was. It was here, 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 here. But I thought, oh, the game is over for DEC. and that was if it was anywhere in here, it's up tenfold from that point. So again, stocks are never too high to buy and never too low to sell, and they tend to, the higher they go, the better they seem to be. So this is a great company and hitting on all cylinders. In the power space, or let's look at a little bit more software. Adobe. So this is broken. I think this was actually the last stock I was short besides Amazon. I'm sorry, not Amazon, Tesla. And I can't remember. I think it was here somewhere in there that I was shorting it, but the market was so strong I didn't want to. I took the tiniest of gains. So Adobe looks broken too. Another software stock. Speaking of Tesla, let's pull that one up. I don't know. I mean, the relative strength is really bad, but Charles Harris talked about potential turnaround on this. And yeah, I don't know if I could ever go long the thing, but I sure don't want to be short it. It doesn't look like a sell. I don't think it looks like a buy, but it doesn't look like a sell. On the power side, so GEV, wow, I should have bought that too. So Charles Harris mentioned this on IBD Live. What a nice little spin-off from GE. Really strong action. CEG, which I don't own anymore, but up 16% in 15 days out of that base. Not too shabby. Not all breakouts work, but boy, some of them to do, and they work pretty well. And then POWL, which I do own. It's thin, 361, $200 stock. Trades pretty thin, jumps around. But boy, earnings and sales and the narrative, I like the narrative of where they are. And thin works both ways. It's only 9.2 million shares in the short, in the stock, in the float. And so thin works both ways. Thin works good on the upside. And so when you're in it and it's thin, it goes up 13% in one day. So it's hard to own, but I'm trying to hold on to that. That's a really good one. So that this power area is pretty strong. HIMS, they announced they're going to sell the GLPs, the Ozempics of the world, and cups without handles are really tough. So if you bought it and you didn't take a quick gain in it same day, and you follow the rules, you'd have got stopped out. But this looks like, if I go to the weekly, it doesn't look that good. I shouldn't have done that. It looks better on the daily. This looks like it could be a potential handle with some kind of buy point like that. Hood, I think same thing. Right? You buy the cup, you get stopped, but now it's building a handle. I don't know if I'm interested in Hood, but I like HIMS better as far as the business. KSPI is interesting. It's a little tougher. Oh, I got best fit off. Oops, I didn't want to print that. Let me go to standard. So it's building not a great base, but again, I like the 99 EPS fundamentals. This is an interesting name. It started to go today and pull back, so that was disappointing, but it's not broken just yet. As long as it holds this somewhere around 120, I would not hold it through there. So my stop is going to be somewhere in this range. I do own this one, if I didn't say that already. Crowd. So it's building a cup, not a great cup. I think Crowd is the type of stock you want to buy in a pullback. So comes down, buy it. Comes down, you buy it, something like that. I don't own Crowd. I just, every time I go to pull the trigger, I just can't seem to pull the trigger on it. But I love the business. I think they're best in breed for whatever that's worth. SMCI. So it's just really choppy. I think this is an avoid. Dell in the same area is very extended, but exhibiting so much more leadership. So like let's look at the 3-month RS rating. I'm gonna open up technical folder. So here, 3-month for Dell is 97 and 98. For SMCI, I'm just gonna guess. I promise I didn't look. I might embarrass myself, but we're gonna try this. I'm gonna guess that the 3-month RS is 40 and the 6-month is 45. Let's see how close I am. So, well, I really missed on the 6-month. It's still 98. So over the last, I guess in the last 6 months, it has gone up a lot still. 1, 2, 3, 4, 5, 6. So it's still, but in the 3-month, look at the 3-month RS is 15. So it's really underperforming in the short term, as exhibited by all this slop. So I like these ratings. I like to see like the divergence. So like if I was interested in Apple, it's a 46 here. It's an 85 on the 3-month, 51 on the 6 months. I'd like that 6-month to improve a little bit. And so if it went from 85 to 70 and this became 60, that would be okay. It doesn't have to be perfect, but I like to see the shorter term moving averages start to outperform if possible, the one on the chart. LPG, really like this one. I've done pretty good in this one before. Kind of a tough cup, but look at the weekly chart. It just kind of just staggers up. It's been a really good one. But this is the new one that I bought, I think either yesterday or the day before. I can't remember. And then my alert went off today. But this is last quarter up. Now for IPOs, you can see that all the quarters are the same. What we do is we take the annual earnings because they didn't report quarterly earnings when they were private. And or because this might be a spinoff actually versus IPO, but or a listing. I think maybe they're listed on the Oslo and now this is a new listing. Anyways, we take the annual earnings and divide equally over 4 quarters. So that's why you get those numbers. And then last but not least, IBIT. So, I mean, I just look at that. It's hard to be bearish on that. You break out of a base, you consolidate. That doesn't look bad at all. I haven't pulled the trigger on it, but I'm tempted by it. And this is the Bitcoin ETF. So there's stuff out there. I'm sure there's stuff that I missed that you guys might own as well. Keep looking, keep doing that work on the weekends. That's how I found BWLP, or find what was the Powell, POWL. I'd done okay in that one before, and I just constantly watched it. I had an alert on it always, and all of a sudden, it out of nowhere, it kind of sets up. Boom, it sets up, builds a cup with handle, and I'm in there buying it. So you never know. You never, like HIMS too. HIMS is one that I had bought and sold in this area, and so gosh, in hindsight, that to me can be bought. I did not buy that day, but that can be. So you just gotta stay on top of them, have your alerts ready, and if an alert goes off, don't hesitate. That's the worst part, is to identify something and then not buy it when it starts to go. Okay, so the quote of the week, Market Wizards. Oops, gosh, I have a typo. Anyways, I'm not going back for that. There, and it's in the back of Market Wizards. And what happened was Jack Schwager interviewed somebody, and this guy talked a lot about intuition and how he traded, and there wasn't really anything that Jack felt was like concrete. And I think the guy who he interviewed decided, I just don't think I want what I said to be out there, because I don't want people to know that's how I trade. I'm in a nutshell, but read it. I believe it's in the back of Market Wizards. I printed it out and I read it every morning, because I just love these are the things that I'll just read every morning, just kind of my affirmations, and just trying to stay in the right mindset, because I can easily get off track on my mindset and blow myself up, so to speak. So I printed out the page, and he says, one of the hazards of doing a book is you can go through arduous process of transforming a big transcript into a readable page, and have the interview subject withhold permission to use the material. So he always allows you, if you're being interviewed as a Market Wizards, to say, I don't like it, you can't print it. He always gives every interviewee that option. That way he can get them to commit. I feel like he gets them to commit more. One of the traders I interviewed, an individual had made several $100 million for his firm, felt that the resulting chapter, which contained a lot of copy related to intuition, dreams, Eastern philosophy, and trading anecdotes, presented an image of him that would be viewed askance by his corporate clients. I have to admit, I don't know what askance means, but I think I know what it means. Like, he was worried they might think there's no process, just kind of seat of the pants. And I trade a little bit, very much on an intuition basis. So this appeals to me. I wish I could read this chapter. I wish maybe one day he'll let him release it. But I love this quote. In trading, just as in archery, whenever there is effort, force, straining, snuggling, or trying, it's wrong. You're out of sync. You're out of harmony with the market. The perfect trade is one that requires no effort. When I find I'm trying to will something higher, I'm hoping it can go up. I stare at it all day. It's not going to work. It's the ones that I just put on and then I just kind of forget about, and they do their own thing. Like Powell is a really good example. I put that on, and the next day it was up like 6. I bought a little bit more, and then it was up 12, and then before I knew it, it was up 20. I just was like, there was no effort. I wasn't doing anything to it. I just let the position just sit there, and I wasn't watching it because I think intuitively I knew it was a good trade and the stock was acting right, and I wasn't worried about it. But there were other stocks that I was staring at constantly that I was worried about. And so I find that if I'm staring at it, if I'm watching it, if I'm afraid to step away from my screen because of XYZ, that's a bad trade. I should be out, or at worst, I should reduce that position. So I really believe in that a lot, especially as you get more experience. Is your intuition will guide you. It's not perfect. There's nothing's going to be perfect. I think Ed Seykota says you have to worry about intuition turning into wishing, which is a great quote as well. So am I wishing for this stock to stop going down, or is my intuition that I think it's gone down enough, or it's in an area where I think there's support, or et cetera, et cetera. So I really love this quote. And again, the Market Wizards books I'm sure most of you have read all of them, but they're great. They really are great. One thing about them is, besides the processes and the philosophies, they're inspiring because everybody's different. They all trade differently. They all have different backgrounds, and they are able to make it work. And it can make it work for you. So you don't have to be Bill O'Neill to do well in the markets. You might not do as well as Bill, but that's all right. There's plenty of money to be made without having to be Bill O'Neill, believe me. So, all right. I know this video might have gone a long ways. I had a lot to say. I think next week I will be off because we'll do the Stay in Step with Arnie and Harold next Thursday. And so, and then in June, got a lot of vacation coming up and be gone for a while. So maybe I might have one of my colleagues do a video. If the market something has changed, we'll try to get some information to you for what it's worth. But I think I might only be able to do possibly one video in the month of June. So have a great long weekend. And then if I don't see you guys, have a great June. Bye, everyone.